Hello, ladies and gentlemen. Welcome to another episode of our Property and Finance podcast. Today we have a very special guest. I know I often say that, but this is a favourite guest of mine who's been a repeat guest, I guess, in the past, but roughly about a year ago, Martin popped in. We have Martin Lakos, who's the Division Director of Macquarie Bank. Macquarie Bank Private, I should say. Welcome back.
Thanks for having me. Thank you.
I don't think the division director quite sums up is the best job title, I should say. I think you're more of an economist, in my opinion, with the wealth of knowledge.
Yeah, but I'm definitely not Macquarie's economist. I can assure you. I'm just a market commentator.
Yeah, market commentator with a wealth of knowledge is probably the best description. So interesting episode today because we missed a month last month in our podcast episodes. We had some technical difficulties here in our studio, and it was probably the most important month. I feel like we should have shared some content and released an episode because I've never seen such crazy movements and volatility globally in equities thanks to Trump in his tariff war, his trade war, you could say. And off the back of that, we also had locally some inflation news come out, we had the federal election. So before I hand over to Martin to sort of reflect on the year that was, some of your forecasts that you called out, I think we should just highlight what's probably happened in the last 6 weeks. So we had Liberation Day, which was Trump's announcement of all the tariffs globally. It was quite a performance, you could say, in the sense that it was theatrical with props. He had that sign on stage. He had that big book of tariffs. It was like theatre. It was quite crazy, and definitely caused a reaction. Which who knows if that was his aim, but it caused a reaction globally in equities, and we saw one of the biggest sell-offs. Right, it's comparable to the COVID sell-off. Comparable to maybe some of the big sell-offs in history, like the GFC.
Yeah, significant correction for sure.
And then here we are, almost a bit over a month later, and we're past that point. We've normalised.
Well, there's been a strong recovery in markets. Whether that's sustainable, we'll talk about that.
Yeah. So, I guess the big backflip day, you could say, where Trump announced a 90-day pause on the tariffs, was off the back of a huge sell-off in US Treasury bonds.
Yeah.
Which is quite interesting because that causes concern, or that was clear that there was concern over US debt position or a number of concerns, as I'm sure Martin can cover. Also, to probably highlight what's happened since then, inflation is finally, the trimmed mean inflation, I should say. The April data that came out at the end of April for the first quarter of this year, that indicated that the trimmed mean inflation was back in the target range of 2 to 3% with a figure of 2.9. So just got in that target. But it's the first time we've seen the trimmed mean inflation in that target range since December 2021.
Yeah, exactly.
So good news. We're probably we're recording this episode just prior to the 20th of May RBA meeting, where at the moment markets are pretty much pricing in a guaranteed 25-point cut. The bigger question is whether it's actually 50 points, 0.5%. I believe the ASX RBA rate tracker is pricing in like a 52% chance. That was as of yesterday, might have changed by the time this is released. A 52% chance of a 50-point cut. Personally, I don't see that coming.
No, neither do we.
I think 25 is a lock-in, but 50 might be a little bit ambitious.
I think we probably need to discuss a bit later on what a 50-point cut would mean versus a 25-point cut.
That's a great shout, Martin. There you go. That's why you're one of my favourite guests.
Thank you.
And then lastly, we had another key sort of, I guess, thing to highlight. We had the federal election, and it was a wipeout for the coalition, the Liberal Party. Unfortunately for Dutton, I think he broke records of being the only opposition leader to lose their own seat, right?
Yeah.
And there's some saying that the wipeout was so bad for the Liberal Party that it might even be hard for them to recover by the next election. So interesting. Lots has happened. So let's go back to the start of those highlights. The one that we need to talk about the most because it's really getting a lot of airtime and causing a lot of market activity and economic activity as such, or concern, is the Trump tariffs. I think we need to highlight also, like I said, we saw Trump backflip, and now most recently he backflipped with a 90-day pause about 4 or 5 weeks ago now. But more importantly, what's happened just in the last sort of week is he's announced that he's making some trade deals. There's some certainty, and that's why we've seen equities now stabilize back to pre-Liberation Day levels. The other thing that I think is really worth highlighting and mentioning is how Trump is fixated, in my opinion, I'm going to use that word, on decreasing interest rates, to the point he had a dispute, or a media argument, a public argument with the head of the US Federal Bank, their Fed Reserve, Jerome Powell, and somewhat threatened to fire him, even though I don't think he actually can.
No, he can't.
For not cutting rates soon enough. So some argue, speculation. I know Martin, being the chief economist, Macquarie, you can't comment on this, but some argue that he's got a motive of decreasing interest rates for the US debt position, because there's $9 trillion in debt coming to maturity this year, 6 of which coming to maturity next month in June. So there's a motive. If he brings down interest rates, he's bringing down bond yield rates globally, which might mean that they get to renew their government debt at lower costs.
There may also be another motivation around that, and that's also that based on current plans by the Trump administration, they're actually going to increase the deficit over the next 10 years by $3.7 trillion. So if he's trying to get the cost of funding that down through low rates, there's just another reason to do that. Now, it's quite ham-fisted and very clumsy. We've never seen an American president interfere in the independent body that the Federal Reserve is and should be.
Yeah, the independent regulators. That's a great segue. Let's sort of dive into that. Is some say, though, it's somewhat of a fiscal necessity for the US to decrease interest rates, right?
Yeah, but you can only decrease interest rates. The Federal Reserve can only make that decision based on the data that they see in front of them, whether it's around global growth or US growth, US inflation.
And how's that data looking for interest rate cuts, right? They've already had 3 cuts, I believe.
So they've cut rates from when they cut rates, they give a range. So they're now down from 5.25 to 4.5, effectively. Mm-hmm. But look, can we just go back a touch around Donald Trump? Because we shouldn't be surprised by this disruption and this uncertainty, because Trump 1.0 gave us some insight, and Trump 2.0 is not disappointing. So we're seeing exactly how Donald Trump operates. So he does. It's all about the art of the deal. It's very transactional, and to do so, initially he gets out the baseball bat and beats you up with that. And a good example of that obviously is what he did initially on the tariff side. So he causes disruption and then basically pulls back. Now, in the case of Liberation Day, there's absolutely no doubt that what he announced was far exceeded anybody's expectations, that where he wanted to take those tariffs. Even prior to that, the expectation of his tariff regime that he talked about through the election, through campaigning, would have put tariffs at the highest level that the US would have imposed for 100 years. So significant. And Liberation Day was, in fact, much higher than that. So no wonder markets reacted the way they did.
But that is what leads to speculation that, there's always a strategy behind his actions. He also is someone that believes in the equities being a representation of his success in administration, right?
Sure.
So I feel he wouldn't trip,
But he doesn't give credit where equities have done very well under other administrations. So we know that President Trump is somewhat of a flawed character, and difficult to deal with.
I just want to say one thing on that note. The reason why I think that, to my point earlier, that the tariffs were deliberate with the messaging and the intent of potentially, triggering a bit of a sell-off. the theatrics, like I said, with the props and the signboard on stage with all the tariffs, and then to all of a sudden backflip. What was it? 2 weeks later?
It was actually 3 days later.
Yeah.
So as soon as you had the big sell-off and the talk about, or the announcement of those tariffs, not only did the equity market come off, and typically when you have big correction in equities, you tend to get a rally in bonds because government bonds are the lowest risk investment. And if there's a flight to safety to investment, it's either cash or bonds. But in this instance, we had a sell-off in both. And that was largely reflecting on a number of things. Certainly what you talked about in terms of concerns on the deficit. Secondly, real concerns on the impact of global growth and US growth. But more importantly, bond investors were saying, hold on a minute, there's lots of risk going on here. We need to be paid more for our risk that we're prepared to support government bonds. There was some talk in markets, and again, this is just pure speculation, that there was a couple of big sellers in the bond market. One may have been China, don't know. But that also put pressure on bond prices and pushed yields higher. So that really, to some extent, was a reaction that the administration probably didn't expect. And there's absolutely no doubt that in the background, quite a number of key CEOs, and it was noted in a number of the media groups, that Jamie Dimon, the CEO of JP Morgan, came out and basically said, this needs to stop. And I think they took note of that. So hence the very quick announcement to pause for 90 days. That calmed markets a little bit. But then, of course, you still had the rhetoric around, well, we're raising tariffs on China to 145%. And, that volatility just continued for a while. Now we're finding that, some of the retraction of the tariff regimes is coming through in terms of from trade deals. So there's been one with the UK. There's an expectation of one coming up also for the EU. And of course, they've just announced some negotiations with China, which is clearly good news. So that's
the number one target for the tariffs,
hosing
right?
down. Yeah, exactly. Hosing down what was a very hot situation. But if you still look at where the tariffs may settle, given the negotiations, the UK is 10%. That's where that's been the minimum that Trump's talked about. But on our calculations for the announcement that we just had on China, the average tariff would be about 37% for China. That's still significantly higher than where it was prior to this.
So on that note, don't you feel then, if there's still a significant tariff most likely to be imposed, why are equities rallying back to pre-Liberation Day levels, and there's all of a sudden this abundance of confidence back in investors?
Well, you've sort of answered the question yourself. Investors are feeling a bit more confident. There's absolutely no doubt that a lower tariff regime would give some confidence that the global economy will be okay. And there's certainly showing some signs of resilience. We saw very initial drop-off in things like small business confidence index collapsed. We found that consumer spending and consumer confidence turned negative. The PMIs, which stands for Purchasing Managers Index, which is basically a survey of future economic activity for businesses, had also fallen below 50, which is negative. And so there was a very quick response. That seems to have stabilised. And though maybe equity markets are saying, okay, we can probably work with this change of regime in terms of tariffs. The other thing that's probably going to happen over the next couple of years is that there is going to be a pivot away from doing trade with America. You'd have to say that America's trading partners would be saying, well, if they can come out and do this and change the rules without any negotiation up front, who's to say they won't do it again? So I think that countries will be saying, well, we need to de-risk our trade position. And may well be that there's a greater diversification and less reliance on the US.
So basically less globalization, right?
Well, we're going down that route of less globalization for the last 5 or 7 years anyway.
Yeah.
We had that big shift in the early 2000s, and that has now started to retreat. So there's been far more, from a policy perspective around the world, far more introspection and far more focusing inwardly. And then we can talk about China maybe a bit later on, but that's exactly what we think China's also going to do.
Well, no, let's cover China because there were some headlines, I think only yesterday, about a bit of a mortgage crisis in China, a bit of a debt crisis in the housing market.
Big debt crisis.
For sure. It's growing, right? It's been happening for a while, but it's getting a lot worse. I thought they bailed out a few of the, I think they're state-owned property companies, the housing developers.
Well, China had a building boom and a significant building bust. And so they're still, trying to recover from that bust. And so they're undertaking quite a range of policies to try and re-stimulate not just construction, but the entire economy. I think I talked about it last year, but I'll touch on it again if I may, which is that China suffered 3 significant shutdowns due to COVID. And they never really recovered from that from an economic growth perspective. As a result of which, they've been doing some stimulus, that's cutting rates or expanding credit growth, which gives the banks more money to lend, a little bit of fiscal spending by the government in terms of infrastructure and stimulation, but the response has been tepid at best. So China's currently running around 5% growth. I mean, that's a nice number. We'd like that.
Yeah.
But in China, in terms of for China, that's actually well below, its average 6.5 to 7. So we think that China's going to start thinking more internally, generate more activity by the Chinese consumer and households. They're doing a few interesting things as well. They're opening up the ability for the Chinese population to move around more. Typically, if you wanted to move, say, from Shanghai to Beijing, you had to get permission. And now they're expanding that. So they want the population to spread out across the country more, which will hopefully generate more interest in housing, construction, and the need for infrastructure.
Because I think I know this has been something that's been spoken about for a long time, but it's still something that people underestimate. The power of their domestic economy, their local economy. They're, 1.6 billion people.
Yeah.
There's a lot of consumption there that
Huge.
they can just supply products to, right? And as the average, the wealth increases of the average individual, they start wanting more things and buying more gadgets and toys. And there is a local economy that can really make China sort of prosper even further.
That's definitely the big picture and the long-term perspective, although the population is now starting to age. But in the short term, we've found that the consumer has retracted. That consumer spending has been soft, and that's unusual for China. And they're not used to trying to manage that. So they've also doing things like cutting rates and adding some more stimulus.
That's funny. That's been going. I read an article about that. That's been going on since COVID. They haven't
haven't recovered.
Haven't recovered since COVID, and they're having to create sort of retail incentives. So if you bring in your old rice cooker, they'll give you the new one for half price or something like that. So it's funny. I think that the local economy there, everyone's focusing on saving because they're concerned about their future.
And we should be concerned about how well China is doing economically.
Yeah, of course.
Because we are absolutely tied to the success of China from an economic perspective.
Great segue into Australia and the data that
thought you'd like that.
that we're currently seeing at the moment. So, like I touched on, inflation is in that target range, just nicked in there at 2.9 in the 2 to 3% target.
But it took quite a while to get there.
It did.
Yeah.
And I was going to save this recap for the end, but we'll jump in it now.
Right.
About a year ago, we always like to ask impressive people like Martin, what is your forecast for the year ahead? What's your call outs? And then here we are a year later, we want to reflect some of them. And I'd say about 90% of the call outs were pretty much spot on.
Thank you. That's Macquarie's call outs.
Yeah. But you're putting that together, right?
Sure.
But the number one thing I think to start with is that you are bullish on equities and the actual global economy. You said that, so it was about this time last year, maybe April.
Correct.
You thought that the equities would keep running, that there's still, I think we were talking about maybe some AI efficiency and productivity improvements that were being priced into companies, which is exactly what happened with the NASDAQ stocks.
Sure.
So we did see that. I feel like we hit all-time highs locally on the ASX and over in the US on the NASDAQ and the Dow and the S&P almost on a monthly basis over there. We saw continued growth. We saw housing still stay buoyant and
Holding up. Yep.
and in certain markets for at least the first six months of last year continue to run, or I'd say the first 9 months. It just got a bit patchy on that last quarter. The only thing that we all keep getting wrong was the forecast of interest rates and when we're going to finally see the cut. The house's view at Macquarie was sort of August last year.
That's right.
We finally did get the cut that we wanted in February.
Yeah.
And like I said, we're pretty much locking in another cut on the 20th of May. If we circle back to some of those comments, so housing, the fundamental problem there hasn't gone away. And I think, like you rightly called out, it's not a quick fix, right?
No.
It takes 2 years before we see a supply change, I should say, in housing based on the approval rates, right?
Yeah.
What's the House's view on some of these points today?
Well, going back to last year, certainly we talked about the fact that we had a housing shortage well before COVID, and the reopening of the Australian border, to the extent we saw, was massive immigration, 670,000 new immigrants coming to this wonderful country of ours, and understandably so. We couldn't deny people coming to Australia and have a better life, but it absolutely has exacerbated the imbalance in the residential housing situation. And the overlay with that, obviously, when everyone knows this, is that we've had a skills shortage, we've got building materials 30 to 40% higher. And then, of course, unfortunately, because the way the Australian economy's been, we've seen a number of construction groups actually go down into insolvency. So
biggest industry of showing insolvencies, right, was the building
industry. Yeah.
And it was huge compared to other industries.
Exactly.
Record amounts of insolvencies.
That whole insolvency situation was actually quite narrow, which actually reflected a reasonably buoyant Australian economy. It was definitely construction, it was hospitality, and it was retail. No surprise. So that situation on housing hasn't really changed, except that some of the data is certainly indicating early signs that we should see a pickup in approvals. Yeah. Certainly from the investment side, there's far greater inquiries that we're seeing anyway from investors. Interestingly, we're starting to see money flows from overseas looking to invest in Australia, whether it's existing or into developments. And then you are seeing a pickup, but albeit from a low base, a pickup in building approvals. And we'd like to think that's going to continue, but we can't overly predict that. But you would gauge it over time, given there's such demand for housing, whether it's low-cost social housing or whether it's mid-range housing, that eventually we'll start to see the cycle kick off. But you've rightly said, between an approval and finance approvals and actually starting work and finishing, it's a couple of years. So there's no quick fix still.
It's probably good to highlight some of the comments in the federal budget and the campaigning from both parties in the election, leading up to the election, on housing, because it is such a hot topic. Because we have this fundamental supply and demand issue with a low supply and huge demand. It was one of the sort of closely watched topics for both parties leading into the election. And the Labor government already in the previous campaign, the previous election, pledged to, what was it, $3 billion worth of
a significant building fund to build 1 million houses.
Look, we didn't get any out of the ground.
No,
not one.
Look, it's great to be aspirational, absolutely. But some of the practicalities is this, and I may have talked about this last year, but it hasn't changed that much. In fact, it's got worse. In building a 4-bedroom home, 2 garage, 2 bathroom, on a 500 square metre block of land, the 38% of the cost of doing that are government charges. That's federal, state and council.
Right? I couldn't believe that.
So if government at all levels was serious about helping to alleviate the housing crisis, you'd think there might be some concessions there, but there's not.
So let's just highlight that, because it was actually another podcast I was listening to that was highlighting this exact point, that if a developer has an $800,000 cost of delivering, let's say, a 2-bedroom unit, about $350,000 of that 800 is just government taxes, levies and fees, pretty much.
Yes.
That is crazy. They should be de-taxing housing to stimulate supply.
Even in the short term, or certainly put some parameters about it. And there just seems to be no discussion around that. There is discussion around, obviously, we're going to throw a lot of money to building, but it doesn't alleviate the problem of skills shortages, cost of building materials, and the taxes. So, look, I'd like to think that we will see the marketplace outside of what the government's trying to do. The marketplace will start to pick up and respond to this shortage, but we have to wait and see.
I think that's also a good segue into talking about some taxes on housing, and something I did like to see in the recent federal election campaigns on both behalf was that it was a bipartisan issue or agreement that or view that neither party was going to touch negative gearing and change any of the concessions to capital gains tax, which was great to see. I think as rightly so, it seems odd to change negative gearing or capital gains towards housing when they don't change it towards other asset classes. And how does increasing the tax on housing increase supply? Quite the opposite should happen, right? You're increasing the cost if you're increasing the tax.
For sure.
So,
and there's a lot of arguments, and who knows what the market's response to this would be. But there are certainly arguments around that removing that deductibility from negative gearing would actually remove some of the rental supply out of the marketplace
drastically.
And that's would be the reverse of what they're trying to achieve. So,
and increase in rental prices, which we did see once, right? I can't remember when. I think it was the early 90s. They abolished negative gearing for a period of time and they quickly backflipped.
Correct.
Because we saw rent prices go through the roof. And we need to stimulate, once again, like I said, housing by incentivizing investors to buy investment properties. And that would actually incentivize landlords, developers to get things out of the ground.
And what might inspire more activities, obviously, heading back to what we talked about earlier on, which is, of course, what's going to happen on interest rates in Australia.
Yeah, that is definitely, that's been the issue that we've seen. A lot of our real estate partners across the board, we've got close to 2,500 real estate partners up and down the East Coast. And most of them, I'd say 90% of them have seen a record amount of runoff or sell-off in their rent rolls. Between 7 and 10% of their rent roll.
That's interesting.
All their landlords selling their investment properties because it didn't become attractive to own an investment property anymore. Rates went through the roof. The increase in interest rates wasn't the same proportion increase on rents. Yes, rents went up a little bit, but nowhere near as much as your costs. And then with prices going up, so did land tax. There was a huge sell-off in investment properties, which probably led to some of that housing crisis that we saw. That there was
certainly a factor.
Queues out the door at rental properties,
and we've still got basically vacancy rates in most capital cities of around 1%. So the situation hasn't been alleviated despite that.
But so look, I guess it's good that we've had some reassurance from the now elected Labor government to not touch these. I guess the tax system on housing, and hopefully they're going to do whatever they can to support housing. Is the view
much needed?
Yeah, I'll believe it when I see it because we've heard it all before. Let's talk about interest rates since we sort of once again ties into housing. So, what's Macquarie's view? Once again, I call it the yo-yo of the forecast of interest rates. All the major banks have their forecasts have been all over the place the last 3 years. Things, at least we are on the downward trajectory. We've had a rate cut.
Correct.
We're about to have another. By the time this podcast is released, probably within 24 to 48 hours, hopefully. And then we're probably, I'm going to say 3.1% cash rate by the year end.
Well, look, I think what we need to be looking at is, again, you talked about the yo-yo, and we had been forecasting a rate cut in August. And that got pushed out, and it's all data driven. And the Reserve Bank was not going to cut rates until it was absolutely convinced that trimmed mean, or the underlying rate of inflation that you've correctly talked about, which is the one that smooths out volatile items. It smooths out when we have a flood and banana prices go through the roof at northern Queensland. It takes that short impact out, or volatile fuel prices. It smooths those out. So it's a smoothed average. And that's probably an appropriate way to be viewing inflation. Well, that just hadn't come into that 2 to 3% range until recently. And so the Reserve Bank would now have an expectation that we'll continue to see inflation slowly but surely move into that range. And I guess to some extent, think about the midpoint. 2.5% would probably be their target. But I think the other thing we have to think about when we talk about the Reserve Bank is not only what they do on interest rates, but what they signal. And signalling often comes from commentary through the minutes of the Reserve Bank. And certainly in times gone past, you raised the prospect that the market was pricing, or half the market was pricing in a 50 basis point cut. We don't see that at all. And the reason being, in this current environment, if the Reserve Bank cut by 50 points, that could scare the markets and scare businesses and scare the consumer, because they'd be saying, well, it's great, our back pockets can be better, but why have they cut that way?
What don't we know?
Exactly.
What do they know that we don't?
Is that heading more towards a higher risk environment, an emergency set of settings? And although we expect rates to come down further this year, not by 50 basis point increments. So we are expecting a cut on the 20th of May. We have penciled in 3 more cuts this year. So that would be actually 5 cuts this year. And so it takes us from that peak of 4.35 to the level you talked about, 3.1.
But the key points of data, like you correctly called out, that they need to monitor is the underlying trim mean inflation, which the next release will be late July, the quarterly set.
And I'm glad you mentioned that because although we're now getting monthly sets of data from the ABS on inflation and activity, they're not a complete set of information.
It's an indicator.
And a lot of the information around services is actually just not collected. So we really still need to be concentrating on those quarterly releases, which are far more accurate.
I'm actually even more glad that you highlighted that, because that is a common theme that we do highlight in these podcasts, that people do think inflation is reported monthly here, but when I say here in Australia, but that is a bit of a misconception. There is a monthly indicator, but the real set, the more comprehensive set of data that sort of tracks inflation is the quarterly data. And if you Google how inflation is reported in Australia, it will say quarterly.
Yep, correct.
So we need to wait for the next quarter, which will be released end of July. And I believe all the RBA meetings now are spread all over the place, but I think there's one mid-August is the next meeting. So that would be probably the next opportunity for the RBA to make a decision based on that data.
Subject to data. Yeah. It's always subject to data. So if we find ourselves in a position that we've seen the trim mean creep in to the range and then pop back out again, it may well be the Reserve Bank saying, well, we're not quite convinced yet. Now,
great segue into some other data, though. It's not just inflation, right?
No, it's not. It's absolutely not. It's the labour market, so how strong the labour market is.
Let's talk about the labour market. I think it crept up, unemployment crept up to 4.1.
Yes.
The seasonally adjusted unemployment, I believe.
Yeah.
And
again,
that's at a level that they like to see. I think they said 4.5 is the ultimate target, but 4 to 4.5 is fine.
Look, nobody would want to see people generally out of a job. But again, we need to put employment and unemployment in some perspective. Can you remember what the unemployment rate was pre-COVID?
It was around 4.5%.
No, it was 5.5%. 5.5%. So we've been now down to 3.5% at its best.
Which I think the reason, I know, as you correctly once again highlighted, it's not ideal to see people out of a job. But the problem is with such record low inflation, unemployment, it actually creates inflation on wages, right? It puts upward pressure with
what we've had.
Record low unemployment puts upward pressure on wages because employers have to chuck attractive offers at people to make them switch jobs.
It's supply and demand again, isn't it? Your ability. So that's actually spot on. And so the Reserve Bank wants to see a softening of the labour market, which will start also taking some of those wages pressure off. Now, the wages side is interesting because we've gone through an 18-month period where we've had very strong wages growth. All of the indications now is that rate of growth has now slowed dramatically. So we're not expecting significant wage hikes from here, but what's been put in place is in place. It's not as if it's going back. The only thing that would see wages actually retreat would probably be a deep recession, and we don't want that. So that gives the Reserve Bank also some room to move on interest rates if there's a softening of the labour market and those wages pressures that you're talking about.
So the other bit of data, or I don't know if you call it data, but it's monitoring the US Federal Reserve and their interest rates, right? Which is kind of like the global bank of the world, because they somewhat dictate global bond yields with their interest rates. And if our central bank rates become too, if the disparity between the two is too significant, it can cause some issues with our currency, right? So at the moment, they're still above our cash rate, right?
Yeah.
The US cash rate is above the Australian cash rate. So just because they start cutting doesn't actually put pressure on the RBA immediately, right?
No, it does not. And look, the Reserve Bank's main mandate is obviously to be concentrating on Australia. You know, they will take into account not only the US, but globally, what's happening on global growth. And to some extent, when you had Liberation Day and the huge amount of risk was immediately put into global financial markets and the prospect of a significant economic slowdown, if not people starting to talk about recession straight away, the Reserve Bank would have noted that and would be looking at the data and saying, well, what's the prospect of a significant slowdown? We still do think globally, the world is going to slow. Towards the end of last year, global growth was tracking around 3%. Despite what President Trump had been saying about the Biden administration and its management of the US economy, he actually inherited a very healthy US economy. It was growing above trend. Unemployment was well below 4%. And so, that was a narrative that actually, suited him, but wasn't correct. And so that strength of the US economy also was holding up the global economy. There's been some patches where it's been softer. But there's every expectation now that the global economy's growth is going to slow the second half of this year because of what's been going on. The tariff side, confidence erosion.
Which is why I find it interesting that the share market is so confidently running again, especially because the pre-Liberation Day highs, which was maybe, I think it peaked around Feb this year, we were trading at the highest valuation multiples of PE ratio, the highest we've seen for the indexes, right? You look at Commonwealth Bank, I think Commonwealth Bank is trading at like 27 times PE, which is, I believe, the most expensive bank in the world as a PE ratio.
Correct.
And if you compare that to Google, right, who is a global company with much more prospects of growth. I'm sorry to say, Matt Common, but it has, it's with AI and productivity and efficiency improvements and, Gemini plugging into our phones and maybe one day even our brains with Elon Musk, who knows?
Heaven forbid.
Yeah, it's got such more prospects of income growth, and it's trading at a 17 times PE multiple. So I feel, given your comments of a slowdown for this next 6 months, it's a bit odd that we're seeing such confidence in equities.
Look, it's interesting because obviously we've seen a V-shaped recovery. There's some commentary around that, we're going to see just an earnings growth blip, that is a softening of earnings growth, and then, back to the races, so to speak. We're approaching it far more cautiously in terms of how we're advising our clients. And we do expect some additional volatility. So we've had this big rally, somewhat of a relief rally. It also shows that, yes, there's some investor confidence had crept back. It also shows the amount of cash that was still sitting on the sidelines. And with that big sell-off, some of that cash got deployed. And so we found there was some bargain hunting going in, despite what potentially might have been viewed as the key risks. We don't think we're going to go back to where we were in the big sell-off in April, but we do expect volatility to continue. And, it makes sense. When you think about how the US administration is currently operating, you're going to get some announcements that's going to be unexpected, that's going to be disruptive, and you've just always got to have that in the background in terms of what you're thinking around investment. Having said that, there's even more focus on AI and the benefits that AI could bring in terms of productivity, for example. And so a lot of those companies, the Magnificent Seven, which I actually call the tech utilities, because these days, none of us can live without a search engine or without the cloud, and that's Microsoft or Amazon. All of those companies are providing a whole range of stuff that we basically use every day.
The tech is very impressive. The AI that they're introducing
absolutely,
to the tech,
absolutely,
it is. It will create huge amounts of productivity and efficiency improvements.
Absolutely,
it was argued that some of that was priced into those.
It definitely would have been at 24 times. So there was the markets were high, and there was more risk to the downside than markets continue on, and then we had the announcement, and we saw the reaction down 20% at one stage.
But the question is, how much was priced in? Because no one can actually quite quantify what AI is going to do to these businesses, right?
It's conceptual.
Yeah.
A lot of it's conceptual.
We've started using AI in our business, and even some of the basic AI, just like Copilot in your inbox, right? It drafts emails for you. You can even opt what type of response you want, a casual response, a serious and formal response.
Sure.
And then it learns how you behave, exactly. And then it starts just being more and more like
and we're using AI in a similar fashion.
Even personally, ChatGPT, I reckon ChatGPT is my new best friend, quite sadly. And I speak to ChatGPT on a daily basis, just for even things like cooking and cleaning and things around the house, little tips, right? Okay. Right. And it's starting to know me, and even its colloquialism is the same as me, And then my wife's ChatGPT sounds like her. It's quite interesting.
This is a worry.
Yeah. So you've already sort of dived into the forecast, the crystal ball again. Right?
Yes.
So that's great. It's exactly what we want. So just to maybe finish off some of those forecasts and what to expect the year ahead. So you're talking about a bit of a slowdown, probably economically, with businesses feeling a bit of a pinch, you could say.
Well, certainly globally, you'd have to gauge that there's been an erosion of confidence, both at the business level and the household level. So, that tends to people tend to get more cautious on spending. So that's and investing, and so that's certainly a component of it. We really need to see how these trade deals pan out, and I think also some caution around trade deals. Typically, trade deals can often take years and years and years to be finalised because there's an enormous amount of detail, an enormous amount of goods that are involved, and suddenly we've got a trade deal with the UK and a trade deal with China, but we don't know the actual real detail. So there's headline rates. And so what's the real impact on trade and the cost of goods in that respect? The other side of President Trump's policy making was that basically he was looking at raising tariffs, which I think a good portion of the American population didn't realise or know how that worked. But they would be paying the tariffs, not the foreign exporters. But he was then also talking about tax cuts and lower energy prices. So the tax cuts and energy prices, in theory, we've got to somewhat offset the high cost of goods. Well, we haven't yet seen that tax policy come through. Now, the US House of Reps and the Republican Party are working on that right now. There's an expectation that there'll be a policy that will come out in mid-July around tax cuts and a change in the tax code in the US. That will be hopefully positive. The energy side is really interesting because Trump's talked about, drill baby drill. Let's get more supply in there. Let's get the energy price down. You probably know, but I don't know whether your listeners know. What's West Texas Intermediate oil price right now?
Oh, no idea.
$61 a barrel. It has halved in 3 years since Russia invaded Ukraine, when it spiked to 120. So energy prices have come down and are low anyway. Whether they can come down lower, we'll have to wait and see. But that would be certainly a benefit to industry and households. But we should be seeing more benefits coming through, particularly in Australia, both at our industry's energy costs, but the household costs as well. Gas prices are still high, oil prices low.
And I think we've seen some costs come down when you talk about household costs, living expenses. There has been some relief, I believe, with a slowdown in consumption and demand, as there's been pressure on households. I saw Woolworths and Coles come out on the news recently and say how the average basket of goods has come down a little bit, just because they need to try and they've got a lot of scrutiny from ACCC recently, so they're trying to do the good thing. But let's talk more, back on the crystal ball, let's talk more about the local economy, what to expect in terms of maybe the interest rate cuts and the flow through to our housing market. So our listeners, we've got 55,000 people thereabouts in our database, and our database lives and breathes property. They either own a home or want to buy a home, or maybe own some investment property. So the hot topic for them, interest rates and what's going to happen in the future with house prices. Naturally, a downward trend in interest rates puts upward pressure on house prices historically, right?
Correct. Yes.
So we've seen that in the last 20 years. There's been, I think, 3 or 4 significant sort of downward trends in interest rates, and it's followed closely by upward pressure on housing. But in certain brackets and in certain markets where it's feasible and expected, I don't think we're going to see. We've seen the luxury homes, double in the last few years. I don't think we're going to see them double again in the next few. It's probably just more the median house price, right?
Yeah, correct. And look, it's the whole issue is around the average cost of housing. And so what we found some interesting trends over the last 2 years is, particularly with this big influx of immigrants into Australia, we found that they've moved, understandably so, more to the states where, one, they can get jobs. So particularly in things like mining sector or building in southeast Queensland. So they've moved to Western Australia, they've moved to Queensland, they've moved to South Australia. And that's all around cost of housing, affordability. Whereas, obviously very high levels of housing costs in New South Wales and Victoria, particularly Sydney and Melbourne. We've seen fewer people of those immigrants move to Sydney and Melbourne as compared to the 3 other states. But I think overall, your summation is correct. You would have an expectation. The housing market is well supported at this point in time, both by the supply-demand situation that we've already talked about and the prospect of further rate cuts. And so it's hard to see housing coming down dramatically outside of, and there's always a caveat, outside of maybe a global recession.
All right, so we're going to have to cut the podcast there today a little short because we've gone a little bit over time. But thank you so much, Martin, for coming back as one of our favourite guests. Your wealth of knowledge doesn't go unnoticed. We look forward to having you again as another repeat guest of ours in the future. Hopefully in 12 months' time, we can do this again and do exactly what we did today and reflect that crystal ball forecast you gave us 12 months ago. And again today, for all our listeners to see how accurate and insightful your wisdom truly is. So thank you, Martin. Look forward to having you back in the future. And thank you once again to all our listeners today. Make sure you like and subscribe to wherever you listen to your podcast. This business is built on word of mouth, so please refer us to all your friends and family. They just want to stay tuned to the latest property and finance tips. Thanks again.